On behalf of HSBC Securities and Capital Markets India, I welcome you all for Jindal Steel and Power Limited Q1 FY19 results conference call. We are pleased to host the management team from JSPL. I would now request Nishant Baranwal, Head of Investor Relations at JSPL, to introduce the management team. Over to you, Nishant.
Thanks, Rajesh. Good afternoon, everyone. It is said, make hay while the sun shines. And there was enough sun last quarter, but instead of hay, we made steel and profits. With this, we welcome you all to our first quarter FY19 earnings call. Begin with, we have with us today from the management, Mr. Ansari, our CEO, Mr. Bharat Arora, our CEO Power, and Mr. Deepak Sugani, our Group CFO. To begin the call, I would request Mr. Ansari to begin with his opening remarks. Thank you.
So good afternoon to everyone and welcome to this conference call. As Nishant mentioned in his opening remarks, it obviously shows that the performance which has been done is really quite remarkable. So it is my pleasure to share some of these results with you. So if you look at our JSPL standalone performance, our production has gone up year on year by 36%. Revenues have gone up by 100%. It's double compared to the last year. EBITDA has gone up by 119%, and EBITDA per ton has also gone up significantly, almost by 50% compared to last year and almost 1,000 rupees compared to last quarter. I would also, since we're talking about standalone, let me also take this opportunity and tell you about how the Angul ramp-up is happening. Angul ramp-up is happening quite reasonably well, the way we expected it to happen. In such a large plant, when you ramp up, there are always methodologies by which you take it to a certain level, then you stabilize it, then you take it to the next level and so on. So that process is on. We are about 55-60% capacity. Ramp up is already, we have reached that level. And going forward, we are quite confident that we will achieve the kind of numbers which we have mentioned earlier in Angul. As far as Raigad is concerned, it continues to do well. It's operating close to about 97-98% capacity, and they're doing quite well. And since we talked about standalone, let me also go to the consolidated performance. In the consolidated performance, our production has gone up by 31% to 1.65 million ton in this quarter. The revenues are up by 71% to 9,665 crores. The EBITDA has gone up by 68% to 2,277 crores. And the EBITDA per ton, as that of course we have already mentioned about it. The PAT in this particular quarter, in the last quarter, we had shared with you that after several quarters, we became positive in terms of PAT on a standalone basis. This quarter, we are very happy to report that not only the standalone basis, but also on a consolidated basis, we are positive in terms of PAT to the tune of about 110 crores. As far as Oman is concerned, which is part of our consolidated performance, they have continued to do wonderfully well. In this quarter, their EBITDA numbers are close to about $68 million. Now that we have got some additional gas and we are also making some modification in Oman plant, we should be able to, from October onwards, the production levels will also increase so that, we can make more metallics in Oman compared to what we are making, and we'll buy less of metallics which we were doing earlier. So that should certainly help us in reducing our cost. And also we have put one additional caster which should also be commissioned by about October or so. So after that, in the coming months, our production should also improve so that Oman performance also will continue improving as the time goes by. If you also look at the overview of steel, if you look at the steel, we see that the market in India continues to be fairly strong, and if you look at the demand pattern which is there with the GDP growth, at some point of time the steel demand also outgrew the GDP growth, and that's something which is very healthy. So we think that we should be able to continue, this entire business should continue improving. Of course, it may so happen in the monsoon period, there is always a little pressure on the long products, so that we might feel that at some point of time. But in the coming months, I'm sure that all that, the prices which are slightly under pressure at the moment will become again much better. So the overview looks very good as far as the imports are concerned. We are, of course, now that the trade fair is something which is, trade fair is there, we do expect that there will be some pressure which might come, but we are well prepared for that. We are very competitive, and we think that we should be able to manage any issue which is coming out of that. So all in all, the steel business in India is looking good. Also in Oman, it is reasonably well. In Oman, we are also, in addition to the local markets of Oman and UAE, which is our stronghold, we have started exporting quite a bit of material to other places like Kuwait, and we are targeting Europe also, so that's another area where we will continue working for. And also, within our own company, there are several initiatives which have been taken to make further improvements. Of course, we are operating at fairly high level, but there is no end to improvement, and we fully believe in that. So there are many, many improvement plans which we have taken up, which in the next few months you will also see will result into very substantial improvements of the overall performance of the company. So by and large, a good performance as far as steel is concerned, and the numbers we have already talked about. You have already those numbers. I don't want to repeat everything. We will cover whatever is balanced, we will cover in the question answer session. Now I want to pass it on to Mr. Bharat Roda, who can talk about the JPL performance. Thank you.
A very good afternoon to all my friends. For Jindal Power, the first quarter of year 2019 has been better than the last quarter of year 2018. But a lot more requires to be done to bring back JPL to its past glory. The availability of coal from the mines which were in the neighborhood was severely impacted during the last year, and some of the mines were closed due to environmental reasons. Fortunately for us, the mine which was the closest to us, and we also have a FSA from Qtr, that mine got restored in this quarter which is under review, and our coal position improved slightly. However, due to the severe shortage of coal in FY18, the stocks at all the IPPs have been extremely precarious, and all IPPs have been highly aggressive in the coal auctions. So to make up the balance quantity which we require beyond the FSAs, we are still struggling in the auctions due to the high prices. Overall, the availability of coal from Coal India during Q1 FY19 has reduced to 137 as compared to 183 metric tons in Q4. The financial performance during the quarter has improved as compared to the previous quarter. We generated 2,751 million units in this quarter as compared to 2,300 million units in the Q4 of FY18, which is up by 19%. The NSR has also improved slightly from 3.49 to rupees 3.56 per unit. The average coal cost has decreased for JPL from rupees 2.38 per unit to rupees 2.06 per unit in Q1. This is primarily due to the availability of the FSA coal, which brought down our average coal cost. However, the auction prices have still been very high. The turnover has increased from 950 crores to 968 crores, and EBITDA from 265 has gone up to 314 crores. The cash profit has increased from 98 crores to 167 crores because of the reduction in the coal cost as compared to the previous quarter. However, when we compare our performance on year-on-year basis with Q1 of FY18, the performance has gone down, as the generation has gone down from 3186 million units in that quarter to 2751 million units in the current quarter. Due to reduced generation and due to increase in coal cost, the EBITDA and cash profit have reduced, because in the Q1 of FY18, the coal cost was as low as 1.62. The plant as such is performing extremely well, and the limited units that are under operation are always giving a very high PLF. However, due to some of the units not being operated due to non-availability of PPAs, The overall PLF has been 37% in the current quarter. The PPAs in the long term have all dried up, and no long-term PPA has come to the market except the one of aggregation of 2500 megawatts by PFC for generators not having PPAs. This was also not subscribed fully as it had an offtake guarantee of only 55%, and coal was not being made available under FSAs for such a scheme. Apart from this, there have been only short-term power procurement tenders which are just valid for a few months. We have bagged about 2 to 3 short-term tenders, and now as on date, we have long-term PPAs for 800 megawatts, medium-term PPAs for 200 megawatts, and another 500 megawatts under short-term and bilateral. The outlook for the current quarter shall be similar to the first quarter. However, the company is focusing on arranging coal from more sources, and some tie-ups have happened, and the availability of coal in the third and fourth quarters will improve, so that the PPAs of over 1500 megawatts that we now have on hand can be serviced properly. Thank you very much.
So now we will pass it on to the CFO, Mr. Deepak Sogani, to talk about the financial performance of the company. Deepak.
Good afternoon, everybody. I am very pleased to announce a very healthy set of numbers in the first quarter. They are by and large in line with our annual expectation of financial performance in the current year. Just to run you through the numbers, briefly. On the consolidated side, our revenues have grown on an annual basis by 71%. On a standalone basis, our revenues have grown by 100%. Our EBITDA on a consolidated basis has grown again on a YOY basis at 68%, and it is standing at 2,277 crore versus 1,353 crore in the first quarter of FY18. Our standalone EBITDA of JSPL has also increased on a YOY basis by 119%, and it stands at 1,645 crore versus 750 crore in first quarter of FY18. Our JPL EBITDA in the current quarter was 314 crore, which was down by 33% on account of the factors that Bharat just mentioned. The EBITDA per ton in our business has also improved very significantly. In the current quarter, the EBITDA per ton is 13,847 as opposed to 9,208 in the first quarter of 2018 and 12,827 in the previous quarter. And I'm very pleased to announce that after 14 quarters, this is the quarter where we have made a consolidated profit after tax of 110 crore. The same figure in the corresponding quarter last year was minus 421 crore, and in the previous quarter it was minus 426 crore. And on the standalone basis also, we have reported a positive PAT of 332 crore as against minus 178 crore in the first quarter of FY18 and positive 145 crore in the previous quarter. I'm also happy to report that the Oman performance is absolutely in line with our expectation from the current financial year numbers and has reported a 68 million EBITDA in the first quarter of 2019. The other thing that I'd like to kind of touch upon, that from our financial point of view, in the current quarter, based on the operational improvement that our credit rating agencies saw in the fourth quarter and the outlook that they saw for the current FY19, we were able to get a credit rating improvement in JSPL from D to BBB minus from all the three rating agencies, CRISIL, ICRA and CARE. And even in JPL, the credit rating improved from A minus negative outlook to A minus stable outlook. So there was a very strong recognition from the rating agencies. On the consolidated debt side, on CapEx side, from a commentary point of view, our consolidated debt reported last quarter was 42,000 crore, And in the current quarter, the reported consolidated debt is 42,670 crore. Although on a net basis we have repaid, some debt, we have also, kind of seen on the reporting side due to foreign currency translation method of reporting, and because of the movement in the currency from 65.04 to 68.58, we have seen a movement of 3.53 rupees on the foreign currency rate, because of which the reported debt figure increased by 700 crore. So on the net, we had actually ended up paying 30 crore. We also would like to report a total capex cash outflow in the current quarter of 532 crore, which is in line with the anticipated capex outflow in the current year. I think with that, I would like to kind of complete my initial commentary on the financials, and we are all ready to take any questions that you may have.
So, operator, start with questions. But before we start with questions, like a comment for all times, since we have the management with us, please stick yourself to more strategic questions. We at IR, myself and Shweta, are always there to help you with the data questions. And also, if we could limit ourselves to 2 questions, it will be great because the queue is long. Thank you. Operator, we can begin.
Thank you very much, sir. Ladies and gentlemen, we'll now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who has a question may press star and 1. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We'll take the first question from the line of Atul Tiwari from Citigroup. Please go ahead.
Yeah, thank you, sir. So my first question is on the capex number that you told for the quarter. So does it mean that for the remaining part of the year, we will do only about 500 odd crore? Because I thought the full year capex guidance was close to just about 1,000 crore.
Yeah, so I think, you're absolutely right. We had said that 1,000 crore is the residual capex that is remaining for our Angul business. And we also said that around 500 crore of sustenance capex will be incurred on an annual basis. So the total cash outflow in the current year would be around 1,500 crore, which will come down in the subsequent year to 500 to 700 crore from a sustenance point of view.
Okay, so basically the kind of capex that we have seen in the first quarter, that number should come down materially going ahead on a quarterly basis. Because there seems to be some kind of a fronting of capex in the quarter.
So that is absolutely correct. If I was to decompose being on a very high level, out of the 532 crore, almost 400 crore would be the capex which will not get incurred in the next year. Yeah.
Okay. Okay, sir. And sir, my second question is on if I try to kind of back calculate your India businesses NSR and the cost on a per ton of steel basis, the numbers appear to be quite high, both on the NSR front as well as on the cost per ton front. So, I mean, any color on that why we are getting this kind of high net realizations and high cost in the business?
No, so I think let me just start off by a commentary on that, and then maybe Ansariji can add on to that. We've seen a quarter where the NSRs have improved very significantly by almost 4,000 rupees a ton, right? And you can see our EBITDA per ton has also gone up in the steel business by almost 1,020 rupees, right? So the cost increase that we witnessed in the steel business is around 3,000 rupees per ton, around 3,000 rupees per ton, right? That's been the core business. Now, what has also happened is that because we were ramping up our Angul business and we were trying to continuously, kind of expand the blast furnace capacity, we at times have, produced more of the grand shots and pooled iron, And some of these other, pooled iron and gram short and DRI and pig iron related sales. So if I was to just try and, kind of give you some decomposition, I think we sold almost 300 crore of, these other byproducts and DRI and pig iron and other stuff, which was a part of the, ramping up process and which has absorbed the residual cost. So the higher cost that you're seeing partially is because of the fact that we ended up selling some of these byproducts which absorb some of our cost structure, right? Am I making that point clear?
Yeah. Thank you, sir. And sir, just the last one from my side. Sir, any comment on the ramp-up of Angul project? What is the kind of per month output that we are seeing from that project currently, and how it is expected to, pan out over next 2 quarters? And when we are likely to see the restart of the gasifier and the gas DRI project? That's my last one, sir.
Right. So let me address this question. So, and when you talk in terms of Angul ramp-up is composed obviously of several very large units, the blast furnace, the BOF, the sinter plant, and all the material handling, etc., which is there. So, when we talk in terms of ramp-up, each of these facilities need to be stabilized at various levels, and it needs to match with each other so that we can have an integrated plan and production. And that is how, the earlier part which was there, which was addressed by Deepak, that is how we also had planned to produce some grand shots and pig iron and so on and things like that. So that's something which is also part of the same plan. The ramp-up is going reasonably well. Obviously, you always want to do better than what it is. You always expect that, we'll do that. But I think these large units, these are one of the largest units.
It looks like the management line just dropped. Ladies and gentlemen, you're requested to please remain connected while we call them back. Please do not disconnect. Ladies and gentlemen, thank you for your patience. We have the management line now connected.
Operator, can we go to the last question again, please?
Mr. Tiwari?
Yeah. So basically I was asking about the color on the Angul ramp-up, especially in terms of, monthly output that you are achieving right now and how it is going to pan out in the future. And obviously the comment on restart of the coal gasifier and the DRI plant.
Right. So as I was mentioning that Angul unit obviously has very large blast furnace, large BOF, and therefore, these units obviously have their own inertia, and you need to take them in a process which is a well-defined process to take it up. And that is exactly what is happening. So for example, in a blast furnace, you stabilize first. How do you make sure that there is this entire coke process is stabilized, the fuel process is stabilized. Then you go for the PCI injection. You make sure that is something which is stabilized, and you stabilize those at different levels. For example, ultimately we want to go to PCI levels close to about 170, 180 kg per ton. Right now we are operating close to about 110 kg, 120 kg. So these are all being done in phases as per a kind of a graduated plan. That's the basis on which it is happening. And therefore, it might look to you that it is somewhat slower, But actually, I think it is very important to run these plants in a very proper manner so that there are no problems. You might have even heard, you have heard of some large blast furnaces in some of the plants where, which have got a lot of experience, that the blast furnaces suddenly chilled out and, they had problems for months and so on. We really don't want to get into any of those at all. We want to make sure that we have this process which is sure and gradual process. So that's the way we are operating this entire blast furnace. And the BF has to match with the BOF, the entire cycle has to match. So that's all happening. So right now we are somewhere close to about 55-60%. And as I mentioned, that going forward by the year end, we should be closing somewhere close to about 85% or so. That's the kind of number that we are talking about. And as far as startup of coal gasification plant is concerned, you are aware that the blast furnace route is a cheaper route for providing the metallics for the BOF and the steel making. And the DRI route, which is somewhat more expensive compared to the blast furnace, we want to start only when we reach a level of the production in BOF and SMS where it is really called for. So, once I reach that particular level, it is something which is, we do that. So we will be, doing this, let's say, in as and when we reach a level of close to about 270, 280,000 kind of production, that is the way that we really want to do. So, once we reach that level, we will certainly start. Now, it might take a couple of months or so to reach that.
Okay, sir. Thank you, sir. Thanks a lot.
Thank you. Our next question is from the line of Amit Dixit from Edelweiss. Please go ahead.
Thanks for taking my question, sir, and congratulations for a good set of numbers.
Mr. Dixit, sorry to interrupt. Could you speak a bit louder? We're not able to hear you clearly.
Sure. Thanks for taking my question, sir, and congratulations for a good set of numbers. It's certainly very comforting for us to see the tinge of green finally after a long wait. So my first question is on the EBITDA and free cash flow. So given we had good EBITDA and possibly with the steel cycle it will sustain, so is there any possibility of us generating a free cash flow this year?
Yeah, hi, Amit. Let me take this question. So, if you look at the larger volume kind of numbers that we've been guiding on, we should be able to do, somewhere around 6 million ton in India in the current year, right? And right now focusing on the free cash flow from the Indian operations, right? And from global operations, obviously, I'll add on, right? If we do around 6 million ton of sales in the current year, I think this is all numerical. I don't think I would like to call it guidance because this is not a guidance. We're just doing a mathematical computation on the call right away. So if we do 6 million ton and if we, let's say, take an average of 12,000 rupees EBITDA, given the fact that in the first quarter our EBITDA is almost 14,000 rupees per ton, hopefully we should be able to average out at least 12,000 rupees a ton in the full year, and we should also see pickup in the volumes. So if you take that computation, we will see 7,200 crore of EBITDA coming into the business, and we have scheduled interest and bank payments of around 4,000 crore in the business, which includes 1,200 crore of scheduled principal repayment. So part of the usage of cash is anyways going to deleverage. So 4,000 crore includes 1,200 crore of repayment. Let me just highlight. And let's take 1,500 crore of capex. So we have 5,500 crore of cash requirement in the current year. And if I net it out of the 1,200 crore of principal that I'm repaying, then I'm talking of 4,300 crore of usage as against 7,200 crore of cash generated from the business. I may factor around 500 crore of working capital which may be needed for Angol, etc. As the business is ramping up. So if you add that, if you deduct 500 of working capital, still we will be left with around 3,500 to, somewhere around that kind of a level of free cash flow, in the standalone business, right? And if you look at the international business, in Oman, anyway, we are expecting to do somewhere around 300 million of EBITDA, and we should have a free cash flow of almost $200 million from there also. Right? So ballpark, the free cash flow situation for the year at this point of time appears to be very positive.
Okay, great. Thanks so much for the elaborate answer. My second question is on Oman. Since we have received the increased gas allocation, so has it come at the increased price or prices as per the old contract?
So, we have the original gas which is available to us is close to about $3 per MMBTU. And this additional quantity which is, about 14-15% additional which is there, this is a marginal higher price of $3.5 per MMBTU. So it's a very marginal increase, and overall it really doesn't affect much.
And it is for how many years? I mean, is it there is some time component to it, or I mean, is it for 10 years or something? I mean, that is the typical contract time, I think, in Oman.
This is for the entire period as per the original contract. So the additional quantity will also be available for the original contract, which is for 25 years, and which is also something which will be extended. So I have no doubt that Oman government obviously wants our business to continue. So they certainly this contract will be redone without doubt. So at that point of time, once we reach that level.
Great, sir. Thank you and all the best.
Thank you.
Thank you. Our next question is from the line of Sanjay Jain from Motilal Oswal Securities. Please go ahead.
Hi. First of all, congratulations for good numbers. I wanted a bit more color in Angul in terms of our casting capacities and the rolling capacities. Where are we, and what is the status of our expansion of coke oven plants?
All right. So, we have two existing casters in Angul. One is a slab caster, the other is a billet caster, and there is another billet caster which has also now been commissioned only recently. So now, therefore, we have three casters available, two billet casters and one slab caster. Between them, there is sufficient capacity to cast close to about 5 million tons of steel. So that takes care of the entire capacity of steel making which we have. So the casting capacity is adequate. As far as rolling capacity is concerned, we have at the moment there are two mills. One is a plate mill and the other is rebar mill. Rebar mill is having a capacity of 1.4 million tons, and the plate mill, which originally was having a capacity of about 1 million ton, we are already pushing it up. Now it should be going close to about 1.5 million ton. So altogether, the finishing capacity there should be close to about 3 million ton, roughly close to about 3 million ton in the times to come. And then the rest of the cast product is primarily to go to Patratu, because Patratu has 1.6 million ton of rolling capacity, and these billets which will be cast from Angul are expected to reach Patratu to match their requirements. So overall, that covers the entire the steel making and casting capacity.
And coke oven, sir?
And the coke oven is something which is, we have two units which are already operational. Two other units are under construction, and those units which are under construction, one is expected to come somewhere between December this year to March next year, and the second one will follow maybe another 2-3, after a few months it will also follow. So right now the balance of the coke we are buying from market. Once the coke oven is up and running, then we will, we'll be able to use our own coke and cut down the cost substantially.
Right. Looking at all this situation and the challenges that you highlighted in ramping up the blast furnace and the steel production at Angul, what is the right guidance, a reasonable conservative guidance for the steel volumes at Angul and Raigad?
So together in India, we are talking about close to about 6 million tons of steel in this financial year, and that's the kind of number that we would expect. And of course, combined with Oman, which will be a little over 2 million tons, that should be upwards of 8 million tons. That's the way it should be.
Yeah, thank you very much.
Thank you. Our next question is from the line of Pinakin Parekh from JP Morgan. Please go ahead.
Yeah, thank you, sir. So two questions. First question is, broadly, the production at the standalone entity has been flat on a quarter-on-quarter basis. So is there any particular reasons or issues that we have faced in any of the facilities while ramping up? And so my second question is on the maintenance capex guidance of 500 crores, which is roughly $70 million. Now, given the facilities that we have both across steel and power and geographic spread that we have, so just trying to understand, is this maintenance capex number low vis-a-vis the depreciation run rate of 4,000 crores annually that will be running on, or is this maintenance capex something which, as the company becomes more profitable, we should see this number spike up?
So for the first part, where we are talking in terms of the production ramp-up in Angul, in the month of April, we also had a shutdown for almost about 10 days or so. And the idea was that there were certain work which are required to be done. As I mentioned, that as you ramp up the plant, you also find out certain bottlenecks, certain items which keep coming up, and you need to take care of that. So in order to do that, we had also taken a shutdown there, and that, of course, has resulted into a little loss of production compared to what one could do that. So, but as I mentioned to you, this is part of this ramp-up plan, and this ramp-up plan, it is very important to operate the blast furnace as well as BOF in such a way that there is, the equipment is totally kept safe and so on. And also we need to make sure that the product which really comes out, that is of the right quality. So it takes a little time to gel in, the production from different units, the quality which is required to be done, the finishing capacity, the raw material incoming, everything, it requires to all be done. And also, I would also like to add that in this quarter also, one of the issues which was there was the logistics issue which was there in terms of rake availability of raw material, etc. But that, of course, had some little impact on that. But combined together, by and large, as I said, we are moving as per the plan by and large, according to the ramp-up plan.
So on the second question, Pinakin, where you wanted to kind of get a view on the maintenance capex, you're right, our consolidated depreciation for the year would be around, 4,000 crore. And our guidance on regular maintenance capex is around 500 crore to 700 crore. That's what we've been believing. I think the color of that is two things. One, from a plant aging point of view, our Angul plant is absolutely new, and, right now we don't expect any major expenditure to happen on that. Number two, our Oman plant is also relatively new, and we don't expect any major to happen on that as well. And third color on that is that, obviously third, even in JPL, when it's a very stable plant, not much of maintenance is required there, it's a steady state operation there as well. And the last commentary on that is the fact that, several, in an ongoing continuous manufacturing plant like ours, we have several, regular kind of ongoing maintenances which are small in nature, which we take it into our regular operating expenses, right? Some repairs, maintenance, some, refractory material. Many of these small things are basically taken as consumed, right? So we treat capexes only those which are, kind of material in nature and have to be, kind of taken as capex projects separate from the ongoing operation. So perhaps some part of the regular maintenance gets covered in our expenditure itself. Yeah.
Understood. Thank you very much, sir.
Thank you. Our next question is from the line of Vineet Malu from Birla Sun Mutual Fund. Please go ahead.
Hi, good afternoon, sir. I just want to know, what are the balance facilities, that we need to commission? For example, it was mentioned that we are putting up a new caster in Oman. We are yet to do some changes in the CGP, to get the production started there for gasifier, etc., right? So I just want to know, what are these balancing facilities which are left, which we need to take care of, and what is the time frame we are looking at to, complete these?
Right. So the first point which you mentioned about CGP, there is no further work which is required to be done in CGP. The CGP and the connected DRI, they are all 100% ready to be operated anytime with the need. So, they are absolutely ready. As I had mentioned earlier, we will start that at the right time. As far as balancing facilities are concerned, in Oman, for example, we are putting an additional caster so that we can produce a little more. On Oman, we had only one caster, so the difficulty which we were facing that whenever that caster is under shutdown, then obviously there was a certain loss of production. In order to take care of that, a caster has been put up. That caster is going to be commissioned by end of October. So it's a question of 2 to 3 months kind of number where it's going to be commissioned, and that will help Oman in doing that. There is no further expenditure, any major expenditure required in Oman at all, compared to that. As far as Angul is concerned, Angul, I already mentioned that the two coke oven batteries which are under construction, they would be completed in this financial year, the first one and the second one thereafter. And the caster has already been set up here. So really there are no further major, there is a project which is already completed, the gas recovery project which is there, that's practically already completed. We now, with another couple of months, we will be commissioning it. In a month or two, it will be commissioned. So further expenditure in terms of balancing, major thing is not there. However, when you build a plant, you make it based on a certain calculation, assumptions and so on, and as you continue operating it, you will find that, okay, maybe if I do this minor expenditure here, it can further improve this entire productivity and so on. So that is something which is that will continue an ongoing process, and for that, we really don't require very large capex, etc. So as what has been mentioned by CFO, the kind of numbers which he has talked about 500 crore or so, that should be enough to kind of cover the entire thing. That's the way it is.
Sure, sir. My question is more point of view of, constraints in achieving full production, let's say. Whether it be any facility, whether it be Oman or Angul, especially Angul, because that's where we are looking forward to production going up. So just want to know, what are the constraints which exist? So you're saying there's no balancing gap which is there anymore. So then other than the ramp-up thing, is there any other concern you're looking at? What is holding us from, firing the CGP again? Just want to understand the operation part.
Not really, there is no constraint at all. The coke oven battery which we have talked, that's not really a constraint in the sense that it really is going to reduce my cost. Today, if I want to operate the plant at full capacity, I can still buy the coke from market and then operate. So it is not really limiting me from operating that, but it will certainly cut down my costs, and that's the whole idea of putting up the coke oven battery and so on. So there is really no additional facility which is really required. No additional major facility which is really required for us to achieve the kind of rated capacity that is already there. As far as CGP is concerned, what we have said is that once we reach a certain level of UIF and steel making operation, then only it makes better sense to start the CGP and the DRI, and that is how we are really planning. So that number is somewhere between 270,000 to 300,000. Once we reach that level, that's the time when we will start the CGP. But to repeat, to answer your question once more, there is no major balancing facility required for achieving the Angul capacity.
Sure. So one last thing is, what is making us have this 300 odd crores of other product sales? Why are we selling so much of iron and not really steel?
So it is something, we are, as I told you, we are in the ramp-up process. So in the ramp-up process, ideally once you stabilize the plant, then what you will do is you will also sell everything as finished product to the extent possible. But when you are ramping up the process, there could always be a little bit of unbalance which is there, and this is one part. In addition, there are also, the opportunities, there are certain opportunities which require, that you may have an option that, okay, if the BOF is ramping up a little slowly, do I continue operating the blast furnace at high capacity? To answer that question, yes, as long as you can make some extra money, yes, why not? We should do that. So that's the process which will continue. That's how that ramping up and balancing scheme will continue. So once we ramp up close to about 80-85% capacity, then it will only be an opportunity thing that whether we really, what product we sell. And the whole advantage which we want to also communicate, that we have that additional flexibility that we can have different products and which can be sold in the market depending on really the margins given at that point of time. So, it gives us the additional flexibility. But today, obviously, it is a ramping up process, which determines that, what we sell and what we don't. So that if there is any addition which is available, we should make and sell it. Does that answer your question?
Yeah, it does. So, lastly, quickly, I mean, sir, what's the status in Mozambique and Australia? That's all.
Vineet, we have a long queue. If I could take this offline with you, would that be fine?
So, I'm done with my question. Just a broad strategic view on Mozambique and Australia. What's happening out there? That's all.
So, let me take that question from an international business point of view. You know, as we have maintained in our last call, given the fact that the Indian business performance is improving, we are, kind of improving, focusing more and, kind of improving the operations in Australia as well as in Africa, different geographies, Mozambique as well as South Africa. We are continuously focusing to improve the production. So, first level of improvement is to take the production forward. And in the last quarter in Australia, we've seen the maximum production per month of around 50,000 tons per month happening. We're seeing gradual progress in the production there. I think that's headline number one over there. Similarly, in Mozambique, we are trying to increase the production there by almost, let's say, 50%. That should happen in the current quarter. So that will be, again, a very large initiative to take the business forward over there. In South Africa, we again are focusing to take that forward. Yeah. So I think internationally, the current focus is to improve the production and operations. Right. While we are looking at other alternatives also on the strategic side, but there's nothing to report at this point of time.
Well, thank you very much.
Thank you. Our next question is from the line of Rakesh Vyas from HDFC Mutual Fund. Please go ahead.
Yeah, thank you so much. A couple of questions from my side. First one on the CGP, sir. Is it fair to assume that given the coal situation that exists currently in India, where even the power plants, especially IPPs, are struggling to get adequate coal, CGP restart will get deferred till time the coal situation improves materially from here?
Not really. It is something, as you are aware that before we kind of stopped the CGP, we had done enough experimentation with different kind of coal which was there, and it was also found that a combination of imported coal and indigenous coal, we can operate reasonably well. So that is something which is possible. On top of it, there are two other factors which I want to tell you there. One is that we also have, now in the government there is a policy for linkage and possibly a grant, and that's something which we are following up very aggressively, and we are very hopeful that very soon we will have some linkages available for that. So that should really provide sufficient coal for that. On top of it, for DRI, we are also wanting to use almost 25 to 30% of the coke oven gas, because the idea is that, the syngas which will be there will be only about 70% or so, 70-75%. 25-30% we will use the coke oven gas, so that, the overall cost can be reduced substantially. So therefore, to answer your question, no, we are not really worried on that scenario. We think that once this linkage is available, and even before that, the imported coal, that's something which we can start with. The only thing we are waiting for is once we reach that level of production, 270 to somewhere between 270, 300,000, that's where we're going to start.
Got it, sir. And my second question is on standalone P&L. So depreciation quarter on quarter, fourth quarter versus first quarter, has increased by almost 100 crore. And if I annualize it and then look at the capitalization that would have happened, it's almost more than 6,000 crore. Can you throw some light? What am I missing?
This is the capitalization of the BOF primarily. A large part of that is BOF. Angul.
So the capitalization happened only in first quarter, not in the fourth quarter. Is that a correct understanding then?
Yeah, it happened towards the end of the first quarter, right? And at the end of the last quarter, in the fourth quarter, that is, around mid of March. So you're right, the capitalization actually took place in the last quarter. However, the depreciation charge relating to the capitalized cost came into the books for the last quarter only for around 15 days. And in this quarter, it is coming for the full 3 months. I think that's the difference. Yeah?
Okay. Okay, got it. Thank you.
Thank you. Our next question is from the line of Parthiv Jonza from NVS Brokerage. Please go ahead.
Yeah, hi. Good afternoon, sir.
Good afternoon.
Yeah, so my question is basically on your international operations. I just want to know when Mozambique, your South Africa and Australia, whenever in future, if they are fully ramped up, what would be the total coal which would be coming out from there?
I guess we are looking at the international businesses. It's kind of difficult to give a commentary on it at this point of time as to what will be the full production level of these businesses, because to take them to their maximum potential, certain other capital expenditures and other steps may have to be taken. So at the management level, right now we are focusing on these businesses on the now and here in terms of what we need to kind of do in the current year period without much of cash outlay. We just want to kind of improve the cash performance from these businesses. I think our near-term focus is that. And therefore, our near-term focus is to double the production of Mozambique, Australia and South Africa. All the three of them we would like to double. It's very minimal cash outlay. When we are talking about very minimal, some more management focus, some limited cash outflow to improve the cash generation from these businesses. That's our near-term goal. We haven't applied mind in terms of the long-term potential, etc. at this point of time.
Okay, and my second question is very general to the business, basically. Just want to understand how the year, 4 months in the year, 4-5 months in the year already over. So how do you perceive this in the next 7 months to go when it comes to the steel industry as a whole?
All right. So, if you look at the Indian steel business as such, we certainly see that there is quite a bit of upward demand on an overall basis for the entire year that I am talking about. For three reasons. One is that there is very substantial expenditure in the infrastructure sector which is happening. And we also see, that there are some private businesses also where we do certainly see that, there is quite a bit of uptick on that. So, therefore, the demand is increasing, and I don't think that since the capacity utilization is already quite large in the country and no new capacity is likely to come very soon, and even in the next few years, because the bank loans are not so easily available now anymore. So therefore, I think for the years to come, and certainly for this year, we do think that demand will continue to be strong. And with that strong and with the kind of supplies that we have, I think the prices are expected to be fairly robust. So we are very hopeful that the steel business will continue doing as well for the year as it has done in this quarter one. That's the way we look. There may be a little bit of
Yeah, and my last question is to do with the NSR. Can you just give an average NSR for this quarter versus the Q1 of last year?
Can we take this?
Yeah, sure. No, not an issue, definitely.
Question, please.
Yeah, thanks.
Thank you. Our next question is from the line of Saumil Mehta from BNP Paribas. Please go ahead.
Yeah, thanks for the opportunity. So, with respect to the commissioning now for the Angul, have we capitalized the entire capex, or there is some capex yet to be capitalized, and what would be the final number on the entire plant?
So I think the bulk of the capex has already been capitalized. The large bulk of the capex, which we just heard on the call from a previous question that came up, was related to basic oxygen furnace capitalization that took place in the fourth quarter of last year, right? There are some small projects that are going on. Obviously the DRI plant is already capitalized. The CGP plant has already been capitalized long time back. So those need not. No. So there are some small projects on the coke oven batteries that are requiring to be capitalized. So I think, in relation with the total capitalization that has already happened in Angul, if I may want to take a view, I would say maybe around maybe at this point of time, not more than 500 crore more of capitalization is remaining. Right?
And now, Angul, barring the CPPs, what would be the gross block at the Angul plant?
Well, I don't know whether we are segregating the CGP gross block versus the total Angul capitalization versus our total capitalization. It would suffice to say that obviously it was a large investment that we made, and we took prudent steps to, kind of recalibrate our plant to make it relevant with the revised, configuration available to us. And we are still trying to leverage the CGP as effectively as we can, as Ansari just spoke about it, so that will follow in due course.
Okay, and my last question, I just missed out, when do we see the optimal utilization of the Angul plant, the plant hitting at 90-95% utilization? Will it take 2 more quarters or, might be extended end of FY19?
So as I said that, by the time this financial year ends, we should be somewhere close to about 85% capacity or so. So that is the way that we really expect, this Angul capacity to be there. Right now, as I mentioned, the ramp-up is happening quite okay. I mean, it might look a little slower, but the fact is that we just want to make sure everything remains safe and so on. So therefore, by the time this financial year ends, we should be somewhere close to what that is.
So, at FY20, the fair assumption should be that the plant should be operating at optimal utilization along with, any benefits of syngas.
By optimal, if you mean 100% capacity, is that what you really mean by the term optimal?
Plus 90.
Yeah, I mean, I would say, yes, certainly. I mean, as I said, that we think that we should be exiting FY19 at somewhere around 85% capacity or so. So certainly in FY20, certainly it should be that.
Sure. Thank you very much and all the best.
Thank you.
Thank you. Our next question is from the line of Rajat Agarwal from Ajinkya Securities. Please go ahead.
Hello. Hi, sir. Congratulations for the good results. Sir, the debt reduction cycle which we have planned, the degree of impact the foreign currency fluctuation is taking on that, and how much debt will we be reducing in the next 1 year?
So, I think we don't have any significant foreign currency debt in the Indian standalone business. Okay? That's the point number 1. We have foreign currency debt residing in our Oman business. We have some foreign currency debt residing in our Mauritius business, and we have some foreign currency debt residing in our Australian business. The Oman business balance sheet is a complete foreign currency balance sheet where the revenues are also in foreign currency. Even the Mauritius takeout is largely expected to be from the Oman cash flows. So again, we have a clear hedge available for the, Mauritius debt as well. And the Australian balance sheet is also primarily a dollar balance sheet because the sales over there are also dollar-related sales, right? So from the reported change in the consolidated debt was primarily a foreign currency translation-related issue rather than a economic issue based on our hedging strategy. Okay? So I think that's one point. Now, in terms of the second question on how much debt we will be able to retire, I think on a normal basis, we have close to 2,500 odd crore of principal to be repaid in the current year between JSPL standalone, JPL and Oman, right? And we have free cash flow, as we just discussed earlier. We have around 2,000 to 3,000 crore of free cash flow coming in India, and maybe another 1,500 crore in Oman. So between this 4,000 odd crore of free cash flow, that is the amount available for repayment. That's net of capex.
Thank you, sir.
Thank you. Our next question is from the line of Abhishek Poddar from Kotak Securities. Please go ahead.
Hi, thanks for taking my question, sir. So there's other income for the first time that you have reported in many quarters of 1.3 billion. Could you explain what is the reason for that? And second is, also we have seen an interest cost declining by about 9%. So what is the average borrowing cost and what level of interest should we see here on?
So your first question is on the other income, is it?
Yes, sir.
There is no other income reported.
Abhishek, are you referring to other operating income?
Yeah, absolutely. My apologies. That's the one, yeah.
Yeah. So this additional operating income of around 60 odd crore is what you're referring to, right?
So on the console, sir, it's about 1258 million, about 125 crores.
Yes, of course. I think this other operating income primarily relates with, the sale of some of the byproducts and sale of some of the scrap-related items, right? Small items in the overall scheme of things.
So would you expect this to be a continuing one, or this will go?
I think if I see it continuing at half of this level anyways, from the numbers that I see right now, so you can say some small, this is not a very large amount in the total P&L. We should see some of it continue for sure, half of it at least.
Right. Sir, is there any specific reason for interest cost to decline sequentially, and what would be the borrowing cost for this quarter for the console entity?
Clearly there has been a bit of reduction in the interest rates also based on our improvement in the rating where we've seen partially, right? And we are expecting some other banks also to pass on some more interest benefit to us. So that's happened. The second reason why it has happened is obviously we started repaying the debt early in the quarter, right? And some of the planned matching additional borrowings happened later in the quarter, small amounts. I guess even that led to a part reduction in the interest cost. And we also saw some refund coming in from the income tax department, which led to a reduction in the interest cost, right? Between all these 2-3 things that I spoke about, ballpark, yes, directionally we've seen some cost reduction in the interest rate. We've seen a small decline in the, debt levels also. And directionally we should be able to see further decline in our debt levels. And interest rates also directionally should come down. But on the other hand, we see the, interest rate curve also hardening. So between the two of them, we are still taking a view that the overall interest rate may not come down significantly, but the cost will come down because the debt levels should go down. That's the view we're taking right now.
Okay, fair point, sir. So just one last question. On the notes to account, you have mentioned that there is an NCLT case where about 1297 crore is, paid to a vendor. Could you explain what was the nature of this transaction and why this money has been, blocked by them?
So I think this is a fairly, we have discussed this many times. It's a clear case. We had been taking, some iron ore fines from Sharda mines where we had given some advances in the past. And those advances and some of our iron ore fines are stuck up over there. And that company has obviously now gone in NCLT. So that's the situation. Right.
Okay, so we expect this to be recovered, is it?
Yeah, absolutely. Meaning we obviously have lodged our claim. They have a fair amount of, liquidity in form of the assets that are available there, right? We see great value of they have almost 12 million tons of iron ore fines available at their, mine. So the mine has a lot of cash value. As and when the issue gets resolved for them, we should be able to realize our cash, right?
Okay.
At least, yeah?
Thanks a lot, sir. Thank you.
Okay, we'll take the last question now, please.
Sure, sir. It would be from Gopal Navandar from SBI Life Insurance. Please go ahead.
Hello.
Yes, Gopal, please go ahead.
Yeah. So can you just help us, understand why this raw material cost quarter on quarter has gone up by 7,000 rupees?
Yeah, I think, let me just say, as you can see that our EBITDA per ton has gone up by 1,000 rupees, the steel making cost has gone up by 3,000 rupees. The additional cost that you're seeing that has gone up is relating to the sale of the byproducts as we discussed in the call earlier. We had additional sale of blank shorts and pooled iron and pig iron and other byproducts. in this quarter. In the process of ramping up, we've obviously sold some of these byproducts in addition to steel. And the cost that relates to these byproducts is the additional cost that we are talking about. Yeah.
So, how should we look at what should be the amount, the normal cost, raw material cost increase quarter on quarter?
I think I said that NSR went up by 4,000 rupees and steel making cost went up by around 3,000 rupees ballpark, right? And directionally, we are seeing that the steel...
So you are saying entirely, whatever we are reducing from the revenue, this 300 odd crore,
right,
is to be removed from raw material costs.
Yes. You are right.
And these sales...
Directionally, let me also make a commentary that as Angul starts, operating at little higher levels, we will certainly, we are all, working to improve the, the cost of steel making from Angul. Right? We should see significant benefit of 2,000 to 3,000 rupees per ton coming in from Angul once it stabilizes. Yeah. Right now it has not stabilized, it's moving gradually. That's where it is.
Okay, and these kind of sales of byproducts, these will continue for some more quarters, or how it should be look?
I think, direction, we are trying to ramp up the blast furnace and we're trying to do the balancing of the plant in Angul. In that process, we are obviously, kind of leveraging the value of the byproducts to enable us to test the plant at different levels at a component level. Otherwise, we'll have to run the entire plant in a balanced manner to make only steel. The flexibility to make these byproducts and to sell them allows us to test blast furnace at a different level, BOF at a different level, and while the plant is still in the balancing mode, some more time, maybe some more byproduct sales may come into our P&L. But eventually, like in Raigad, we don't see much of that. So eventually, once the Angul is stabilized, this should come down, right?
Okay. And, sir, can you just help us understand how the steel prices are currently versus the, average of last quarter?
So, if you look at the steel prices, we have already seen that the NSR in the last quarter has gone up significantly. And if we talk about the current prices, the current prices, let's say, as we speak. So obviously, in the monsoon period, as you're aware, the long steel prices in India, normally the demand comes down because the construction slows down, the material, people don't really have places where they can keep the material and so on, they don't unload, etc. So generally, that is what happens every time in India, and this is no different. So therefore, this time also the demand for the long product, we certainly see that there is some reduction in that, and therefore, the prices have marginally come down, especially for the long product, not so much for the flat product. So, for example, in the long product, I would imagine that compared to last quarter, today the prices might be down by about 2.5–3% kind of a number. And, that's the kind of number which will be there. But we also see very, very positive signs in the sense that only a few days back, the secondary sector has started also putting up the price, the prices are going up. And that's a very positive sign because what it indicates that we have already bottomed up and, from now on, the prices are going to go up. So I am very hopeful that by the time September, in the middle of September or so, the prices will be somewhere very close to what they were in the month of June.
See, from the indications we have, it appears that whatever, inventory levels were there in the market for long has come down. And we will obviously see a significant price improvement happening in the, coming months. So that's our broader thinking on the matter.
Absolutely.
And, sir, lastly, was there any forex gain or loss during the quarter in the operating profits?
Gopal, can I take this data question separately with you? This is Nishant here.
Yeah.
Sure.
No,
thanks so much.
Okay, thanks a lot, sir.
Thank you, ladies and gentlemen. That was the last question. I would now like to hand the floor back to Mr. Rajesh Lachhani for closing comments. Over to you, sir.
Yeah, thank you all for joining the earnings call. I'll hand over the call to the management for any closing remarks. Over to you, sir.
So thank you very much. I would like to thank all of you for so much of interest in the company, and certainly, it has been a wonderful quarter. There is one more news which I wanted to share at this point of time. You might have already read that after a initial struggle of almost about 14 to 15 years, we have finally been able to get Indian Railway major order for the rails. And that's a very substantial order of close to about 100,000 tons, close to about 560 odd crores or so. So therefore, this opens up a new chapter for us because, for so long we were really trying to get these orders. Now within India itself, we are now in a position to supply rails for all the passenger traffic. So far, whatever we had supplied was more for freight, etc. Of course, we had been supplying rails outside for passenger, but in India, this is going to be the first time. So this is really a very major breakthrough for us, and we wanted to share that information also with you. And I also want to, in the closing remarks, I also want to tell you that we rest assured that Angul ramp-up plant is happening quite well. Despite what might look like a flatter production in this quarter compared to last, because we just want to make sure that everything really gels very well, and you will see the results in the later half of this year. So thank you very much for listening.
Thank you very much.